Hi there, I'm Edward Galstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're taking a closer look at RTX Corporation, previously known as Raytheon Technologies, a major player in defense and aerospace, known for everything from missile systems and radar tech to jet engines and avionics. With the world spending more on defense due to the new NATO 5% rule and the industry facing both opportunity and disruption, how does RTX stack up based on the fundamentals? We're going to break down RTX's stock using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. First up, is RTX turning its investments into real value? RTX's return on invested capital sits at just 5.3%, well below our preferred 15% benchmark and meaningfully lower than Lockheed Martin's 13.4%. That suggests the company is having a harder time turning investment dollars into real value. Meanwhile, return on equity is 7.3%, again on the lower side for a business of this scale. Unlike Lockheed, equity hasn't been aggressively reduced through buybacks for RTX, so this number is more reflective of true operational efficiency. These are mediocre returns for a company with this much government and commercial exposure, and that's a red flag for long-term capital compounding. Is RTX delivering consistent performance? RTX's growth story is mixed and frankly a little troubling. Over the last decade, revenue grew at a compounded annual growth rate of just 4.1%, indicating sluggish top-line expansion. Net income grew at a CAGR of -5%, pointing to declining profitability over time. Earnings per share CAGR is even worse at -9.4%. That's not what we want to see from a company trading at a premium. While defense spending is on the rise globally, RTX has struggled to translate that into growing earnings, possibly due to integration challenges from the United Technologies merger, commercial aerospace volatility, or cost pressures. Unless management can reverse these trends, this weak growth profile is a serious issue. Let's look at financials. Is RTX on solid footing? RTX currently holds $5.6 billion in cash and short-term investments and $43.3 billion in total debt. That's a pretty wide gap, and unlike Lockheed, RTX does not generate enough free cash flow to cover a significant chunk of its debt quickly. Their debt-to-equity ratio is 0.7, which looks modest on paper, but keep in mind, equity is still inflated from the merger with United Technologies in 2020, so this may understate real leverage. Overall, the balance sheet is stretched, and unless profitability improves, the debt load could become a drag on flexibility and shareholder returns. Even great companies can make poor investments if you overpay. So how is RTX valued today? This is where things get tough. RTX trades at a price-to-earnings ratio of 42.8, more than double that of Lockheed Martin at 20.1 and Northrop Grumman at 20.2. And even higher than many growth-focused tech stocks. And with earnings per share declining at -9.4% CAGR, that gives us a PEG ratio that's negative and completely unsustainable from a valuation standpoint. Investors are paying a huge multiple for a company with negative earnings growth. That simply doesn't add up, unless they believe in a rapid turnaround, and even then it's a gamble. Well, what about RTX's economic moat? To be fair, RTX does enjoy a real competitive moat. RTX has deep relationships with the US military and NATO allies. They also have advanced technology across missile systems, radar and aerospace engines. There are enormous switching costs and regulatory barriers. But here's the catch. Having a moat doesn't mean much if you can't generate strong returns on capital or earnings growth. RTX has the relationships and the technology, but unless execution improves, the moat won't be enough to justify the price. Before we wrap up, you might have noticed the clean, detailed charts in this video. They're powered by Fiscal. If you want to upgrade your investment research, Check out the link in the description for a 15% discount on Fiscal's premium tools. Here's what our 5 key factors reveal about Raytheon stock, and the results might surprise you. Return on invested capital 5.3% and return on equity of 7.3% are below average. Earnings per share and net income are in decline, with negative long-term CAGRs. $5.6 billion in cash versus $43.3 billion in total debt makes the balance sheet concerning. Their price to earnings ratio of 42.8 with negative earnings per share growth is unjustifiable. Raytheon has a moat, but it's not enough on its own without solid execution. In my view, Raytheon stock is significantly overvalued, and the fundamentals don't support the current stock price, especially when peers like Lockheed and Northrop are cheaper and growing faster. It might have future potential, but right now it doesn't look enticing. What's your take? Overhyped or misunderstood? Comment below, hit like and subscribe, and I'll see you in the next one.